Hey, this is Yoshi. I run a small investment firm that specializes in REIT investing, and over the past year I've predicted quite a few REIT dividend cuts. Among others, I predicted that Global Medical REIT, Service Properties Trust, Easterly Government Properties, and Crown Castle will cut their dividend, and they all did. Today I'm back with another round of dividend cut predictions, so make sure to listen till the very end. Some of these REITs are very popular, often pitchy on YouTube, Seeking Alpha, Substack and elsewhere, and yet I think that they are likely to cut their dividends, which could lead to significant capital losses. Before I get started, can you please do me a huge favor and click the like button, subscribe to your channel, helps me a lot to keep on growing. Thanks so much in advance. So the first REIT I'm gonna discuss is called Brandywine Realty Trust, ticker symbol BDN. This is a REIT that's very popular on Seeking Alpha specifically because the REIT owns high quality assets, it has a shareholder friendly management team, and yet it's today offering a 14% dividend yield. Moreover, many investors appear to think that this dividend is sustainable because it was already cut once in 2023, and therefore investors seem to think that it was already reduced and therefore it should be sustainable going forward. But I hate to be the bearer of bad news here, but I think that the dividend wasn't cut enough in 2023. It was only cut by about 20%, and I think that another cut is just around the corner. The problem here is that the REIT is mostly invested in office buildings in Philadelphia, which is struggling today. To be clear, these are high quality properties and they should do fine over the long run as they will benefit from the flight to quality. But the problem is that the office market is really tough today, especially in Philadelphia. Average vacancy rates are above 20%, and therefore all landlords, including those of high quality buildings, have to provide significant leasing incentives to find a tenant. This is forcing landlords, including Brandywine, to heavily reinvest in their properties, which is draining their cash flow. For this reason, I don't think that FFO, which stands for Funds from Operations, is a good metric to assess the cash flow from Brandywine and other office REITs. FFO doesn't account for leasing incentives, capex, and so on, and therefore it often overstates the actual free cash flow generation potential of the REIT. In this particular case, the dividend appears to be fully covered by FFO, and this is what's giving a false sense of safety to REIT investors. But once you adjust for capex, leasing incentives, and so on, the dividend is very poorly covered. The management is actually providing their own guidance for cash available for distribution, which is a better metric to assess the sustainability of the dividend, and they are guiding it to be at 120% to 150% payout ratio based on this cash flow available for distribution. And so clearly the dividend is not sustainable, it's not covered, not even close. And what's making matters even worse is that the REIT has quite a bit of leverage. Its debt to EBITDA is about 7 times, its debt maturities are relatively short. And I just don't think that things will magically get better for the office sector in 2026, 2027. On the contrary, I think that the AI revolution could significantly hurt this property sector. Right now, companies don't really know how much labor they will need in a few years from now, and this uncertainty will likely delay major leasing decisions for office space, further hurting REITs like Brandywine. And so ultimately, I think the dividend is unlikely to be sustainable. I expect a fairly significant dividend cut of 30 to 50% already in the near term. The second REIT I expect to cut its dividend is called Innovative Industrial Properties, ticker symbol IIPR. This is a cannabis REIT, and I'm less certain about this specific REIT. Maybe it will manage to sustain its dividend, but most likely it won't, in my opinion. This is a high quality REIT, just like Brandywine, in that it owns high quality assets. It has a very strong balance sheet with only a 15% LTV. It has a shareholder friendly management team that has a great track record. But the problem here is that the cannabis sector is facing significant struggles. Tenants in many cases in this sector are unprofitable and rely on capital raises to be able to cover their rent payments. But the cannabis sector has now been in a multi-year bear market. Valuations are very low, and therefore new equity raises are highly dilutive. Some tenants are already defaulting on their leases. Not too long ago, this specific REIT had its biggest tenant representing 17% of its rental income default on its lease. Since then, it has found a resolution that limited the damage, but some other tenants are also struggling, and I expect further lease defaults over the coming quarters. This would be fine if the REIT had a low dividend payout ratio, retaining some cash flow to serve as a buffer in case of such issues, but unfortunately the dividend is already today poorly covered. The payout ratio is slightly above 100%, and so if it faces further lease defaults, then the dividend will likely need to be cut. The market is not giving the REIT any credit anyway. It's pricing it today at a 14% dividend yield, so they might as well cut it in order to be in a stronger position to negotiate with tenants as they default on their lease and they try to find a resolution. This REIT only has one close peer, which is called New Lake Capital Partners. We actually prefer that REIT and we invest in it at High Yield Landlord. By the way, if you want to access our full portfolio, you can join us for a 2-week free trial. It will be the first link in the description of this video. But this specific REIT, we prefer it because it's retaining nearly 20% of its cash flow and has zero debt on its balance sheet. It's actually strongly net cash positive even, so it's in a much better position to deal with occasional lease defaults, which are inevitable in this property sector. Ultimately, I think that innovative industrial properties made the mistake of being a bit too greedy. It started taking debt despite focusing on a very risky property sector. It set a payout ratio that was too high, not leaving enough margin of safety for the occasional lease defaults, and this has now put it in a difficult situation that might force it to cut its dividend. The third REIT I expect to cut its dividend is called Community Healthcare Trust, ticker symbol CHCT. Again, this is a very popular REIT because it's offering an 11% dividend yield and it's focusing on healthcare properties like skilled nursing facilities, which are recession resistant. And because of that, I often see headlines on different investment forums pitching it as a recession-resistant 11% yielder, but if it sounds too good to be true, it probably is, and I think that this is the case here. The REIT is able to offer these very high dividend yields because it's been buying a lot of risky assets with cap rates at 8, 9, or even 10% in some cases, and you don't get such high cap rates in the healthcare sector without taking significant risks, and this is now starting to lead to some lease defaults. Again, this would be fine if the REIT had a strong balance sheet with low debt, long debt maturities, and it was retaining enough cash flow with a low payout ratio, but none of this is true here. It has quite a bit of leverage and its payout ratio is already above 100% based on FFO. If you adjust it for capex, leasing commissions, and so on, I think it's closer to 110, 120%, which isn't sustainable. I've seen this play out many times in the past and I don't think that will end up well for shareholders. I think that once again this REIT is likely to cut the dividend by at least 20 or even 30%, which will likely lead to some capital losses. So as you can see, not all of REIT dividends are safe. There are quite a few REITs that are over-leveraged or own risky assets, in some cases also are poorly managed, and therefore their dividends might not be sustainable. If something seems too good to be true, it probably is. But to be clear, I actually think that most REITs are in a good position to keep growing their dividends in the coming years. That's because leverage is at an all-time low in the REIT sector, rents keep growing in most property sectors, and most REITs also have very low dividend payout ratios of just around 70%. Remember that the 90% rule that you often hear about is based on taxable income, which is quite a bit lower than the actual cash flow because of non-cash depreciation. I expect most REITs in my portfolio to keep hiking their dividends steadily over the coming years, and if you want to access my full portfolio, you can join us for a 2-week free trial as I mentioned earlier. This is a real 2-week trial in that you won't be charged anything in the first 14 days, so feel free to join, check it out. If it's not for you, you can cancel anytime, no questions asked. Once more, if you could please click the like button, subscribe to your channel, I would greatly appreciate it, and let me know in the comment section below what REITs I should cover next. Thank you very much and see you at my next one. Bye bye.